If you have invested into a local fund that concentrates and mimics or benchmarks the Kuala Lumpur Composite Index, you probably be very frustrated. Why? Because in 2016, the index was hovering around 1006, and today it's still around 1006. So net over 10 years, you've literally not made any money. Now, there's an uninvestable narrative that a lot of foreign funds has been net sellers over the past few years. And the ringgit back then was 4 ringgit 70 cents against the US dollar. And there's a lot of narrative they say Malaysia today is not investable. And take your money into a foreign portfolio or even a global portfolio of stocks. Is that really true? Is that something that you want to base your decision on? So this video, we're going to try to address and looking at the data whether the Malaysian market is still investable. Hello everyone and welcome to the channel. For those of you new and don't know me, my name is John. I was a former engineer turned full-time investor, now a wealth planning director at Philip Wealth, where I help clients with their equity portfolio. I'm also the author of an upcoming book called The Malaysian Multi-Baggers that should be out in stores Q1 2026. As someone who helps clients with their equities portfolio, I love it when everyone just hits the market. Everyone just says, it's uninvestable, you sure lose money, don't take your risk on it. Because as value investors, we should always be contrarians. We should always invest not when the market is hot, when everyone is chasing after the stock, but when it is actually sick, when it's actually on the operating table, when nobody wants to touch it, because that's where you find bargain values for great businesses that should help you compound your portfolio. I'm also going to show you data sets why I believe the KLCI index, for that matter, is not a very good benchmark or indication of where you should put your money, because a lot of the components in the index do not really represent the strength of the Malaysian economy and the strength of the Malaysian capital markets. And we have great businesses within the capital markets, but it's not really represented by index. So I'll share with all of you this shortly. So one of the first data points I look at is this thing called a valuation disconnect. Now, how do we normally value a company? It's not really just through the share price, but a relative measurement like the price to earnings ratio. So for those of you unfamiliar with the price to earnings concept, is literally taking the price or the market capitalization of a company and then divide it against the earnings or the total net profit of the company to see that, hey, what is the multiple times I'm paying for the earnings of a particular company. So let's just say the entire market cap of company A is 10 million and the earnings is 1 million. So you get a P ratio of 10, or that means it's 10 times or multiple of this particular earning. So the KLCI is trading roughly about 13 to 14 times forward earnings. That's a 10-year historical average low, because the 10-year average is roughly about 16 times, and we are trading nearly 2 times standard deviation of that. So if you're buying a Malaysian conglomerate or any company, corporate earnings, you're getting a 15 to 20% discount in terms of valuation when you buy a particular Malaysian business or particular Malaysian stock. Let's look into some sector-specific valuations. During the pandemic, a lot of Malaysian technology companies were trading 40 to 50 times PE, and it was compressed down, 25 to 30 times post the pandemic. The bubble actually burst, leaving a lot of these high growth, high valuation companies to come to a point where we can consider a little bit more fair value. Now, what is considered fair is very subjective. Obviously, it's very dependent on industry, sector, and the type of the company. But most tech companies command a slightly higher relative valuation, sometimes even 25, 30, or even 40 times. And some conglomerates, there's one example of a conglomerate that touches our everyday life, which is QL Resources. At the peak, they were trading at probably 50, 60 times multiples of their earnings. So once the bubble bursts, a lot of these valuations or PE has been compressed, and that's where you find good bargain or good value. What about the small mid-cap construction companies? They've been beaten down quite heavily because of a lot of political instability actually. A lot of projects like the MRT3 and all that were delayed. There was not a lot of capital spending by the government, and look at what happened. Order books were really bashed. But today we're starting to see an increase in construction activities, especially about data centers, which I'll talk about shortly. There's always a look forward to more utilities, more infrastructure spend within the country. And all this has been hampered because of tax collection, because of subsidy in the past. I mean, the government needs to collect more money before they start spending money. And that is something that cannot be done if there's a lot of political instability. Right now, with the opposition creating less havoc to the coalition government, I think that's where business as usual will come more and more into play, and that's something that I look forward to. That particular catalyst of stability. Another data point I want to point out is actually the dividend yield that some of the KLCI companies are actually offering. Obviously, I'm taking an average here, but if you take an average of the KLCI large cap, it's offering a dividend yield of average about 4%. Now, if you compare that to the S&P 500, it's yielding roughly about 1.5. So, in a very volatile world where some people are saying there's an AI bubble, I think getting paid 4% to wait is pretty much a luxury. The next item I want to talk about is really that foreign outflow of capital from the capital markets. So I'm not going to deny it. Definitely there's a lot of billions actually of net foreign capital outflow from the Malaysian market. And these are all hot money. We call it hot money. We call it money that likes to follow a trend, likes to follow a particular allocation strategy to try to chase for returns. And all the factors I mentioned earlier, political instability, not much catalyst for construction growth and all that, a lot of it has left Malaysia, especially from the capital markets. However, looking at another data point, money coming in, the foreign direct investments or FDI money, that has been flooding in at a record rate. I mean, as of 2023, there was 329.5 billion coming in. There's even more numbers coming in 2024, and definitely higher than what it was generated during 2022, right after the pandemic. And what we are seeing, I think, is so obvious. There's a lot of hyperscalers or data center cloud providers coming to Malaysia. I think they're attracted by cheap electricity costs. I wouldn't say abundant. I think it's getting to be a point of scarcity of water supply, but they know that Malaysia has been very blessed. It's free from a lot of climate adverse weather. You don't have earthquakes. You don't have massive floods. You don't have tornadoes here, and I think it's a great place for them to set up, especially the hyperscalers, to set up data centers and to actually position it as a hub for the Southeast Asia region. Leaning more into the AI data center catalyst, there's also a multiplier effect that benefits utility providers, someone like a Tenaga, someone like a YTL Power, and also Renhill Berhad for water supply. That is one, utilities. The second multiplier would be properties, guys actually owning tracts of land large enough to house a new data center. That's also a multiplier effect. And last but not least, the very skilled large-scale construction players, people like Gamuda, people like Sunway, that build more and more expertise. They have the ecosystem and the machinery to actually provide this professional service to these hyperscalers. So the clusters of new projects, especially down south in Johor, within Cyberjaya, where there's high bandwidth connectivity, there's supply, I wouldn't say ample, but there's supply of electricity, is one of these catalysts that Malaysia should be looking forward to. The second catalyst is really the China plus one supply chain. Now, what do I mean? Because of the trade war between the US and China, even a lot of Chinese players are trying to I would say diversify their supply chain and trying to circumnavigate the blockade, the tariff restrictions for suppliers coming directly out of China, and positioning Malaysia where language is not so much of a barrier. There's already an established ecosystem. We call it the Silicon Valley of the East, which is in Penang. This is mutually beneficial for both China as well as Malaysia. May not be music to the ears of existing players within the Penang tech ecosystem, but I think somehow if the players from both sides can find a middle ground and benefit each other, I think this is a direct boost to the electrical and electronic sector, especially more for the semicon, which contributes about 50% to 60% of Malaysia's exports. So, even though it's just a pass-through where there's a little bit of value-add manufacturing and then it's shipped out again, I don't mind because it creates much more multiplier effects to the ecosystem players, people who do machining, precision machining work for semicon, people who help create testing equipment, people who help manufacture, especially the OSAT players, the outsourced semiconductor assembly and test players. These are all beneficiaries of the tech supply chain shift, China Plus One. I like this catalyst much more than the data center shift, where the multiplier effect is it doesn't create as much high value jobs as the tech supply chain shift. And last but not least, I think the third catalyst I've mentioned earlier is really that political stability and fiscal reform. We're starting to see subsidy rationalization. A lot of this is very painful to the rakyat, but it's actually a good or bonus point for the investor because fiscal discipline of any government is actually good. More money towards the government coffers. You hope to see more either infrastructures being built, either good fiscal policies to stir the local economy, probably grants to help businesses get off the ground and to scale. These are things that I think would really benefit us as investors, and a stronger ringgit today is we are benefiting. I mean, remember earlier 4.7 to the dollar, today it's roughly 4. If raw materials are imported with a stronger ringgit, then it's actually cost beneficial for these players. At the same time, if you want to be a global investor, and which most of my clients are, we are actually buying global businesses at a stronger ringgit compared to 2 to 3 years ago. So to conclude from all these data points that I show you, I think it's not a wise strategy to go out and buy a KLCI index, because if you look at what are the components of a KLCI index, it's very much weighed down by the old economy, banks, GLCs, plantation, that may not enjoy growth of what the three catalysts I mentioned earlier, which is the hyperscalers coming here, foreign direct investments, China Plus One strategy, and also fiscal reform and policies where Malaysian governments actually want a lot of more global champions rather than Malaysian champions. So if you're buying the index, especially the large cap companies, and a lot of unit trusts or fund companies are actually hugging the index, then you might not enjoy that kind of growth that comes with the smaller companies compared to the index. And in Malaysia, it's really a stock pickers market. You want to own those companies in those sectors that I mentioned, even renewable energy, where those companies that can generate profit margins or internal rate of return in excess of 5, 10, 20, even 20%. It's not easy, but if you can find companies that can generate rates of return that are above double digit, then I think you're in for a good ride, provided that you bought it at the right valuation. So it's really a stock pickers market, and really you need to understand the industry and the catalyst that drives those industry. So I've actually increased a lot of my clients' allocation into Malaysian equities for the first time in 5 years, but obviously I'm very selective. And if you're looking at your portfolio and you're a little bit confused, or you want to see like independent, or you want to seek independent review of your portfolio, let me know in the comment section, or hit me up at my email in the comment section links below. So I look forward to seeing you in the next video.